Good afternoon, everybody. This is Renee Daggett, and we're so glad that you can join us on this webinar, How to Read and Interpret Financial Statements. We're just going to go through a short presentation here. I do have Nikki and Sabrina on the line. Nikki is our bookkeeping manager. She mentors and manages all of our bookkeepers, and then Sabrina mentors and manages all of our tax department tax pros. So most of you know me, I'm Renee Daggett, and I'm just going to give a short presentation. The presentation is educational purposes only, and it is not meant to give you tax advice for your specific situation. At the very end of this presentation, there'll be an opportunity for you to ask questions, whether it has to do with financial statements. Last month we talked about home office deductions, or really anything, any questions that you have about running your business. We are here for you. It's kind of like one of those privileges of having AdminBooks on your team. So write a note of what you have questions about, and Sabrina and Nikki are here to answer as well. So here's our agenda for today. We're going to talk about common mistakes that people make on their financial statements. We're going to, I'm going to share some information of why your financial statements are important and what one line on the financial statement do you need to focus on first to kind of get grounded. It's the basis and the foundation for everything on your financial statements. I'm going to give you a definition and examples of a term us accountants use called above the line and below the line. And I'll dive into some details there. I'm also going to talk about how your entity will determine the way you set up your chart of accounts on your profit and loss and your balance sheet. Super important based on what's deductible, what's not, versus S Corp, sole proprietorship, C Corp, LLC partnership. So I'm going to talk about your entity. And then we're going to look at some statements and give you some examples. So the first thing I want to do is have Nikki and Sabrina share with you some common mistakes that they see on their side, whether it's Nikki cleaning up somebody's bookkeeping, financials in QBO, or whether it's Sabrina on her side and she's preparing an S Corp tax return. What are the common mistakes people make so that you know about those and can avoid them? Ladies, I didn't decide here. Who wants to go first?
I'll go first. I'm talking before I turn on my microphone. So as I am working on cleanup projects, I think that there are three common mistakes that people make who are using QuickBooks Online or even QuickBooks Desktop. So the first mistake I see a lot is that, especially those who are using bank feeds as part of their workflow, they feel like if they have all of the transactions that are coming in through the bank feeds, that they don't need to reconcile their accounts. And that is a really big mistake. I get a lot of cleanup files where they've accepted all these transactions but never reconciled. And reconciling your accounts is really important because many times there are duplicates in the registers that overstate your expenses or overstate your income. So reconciling back to your bank statements is really important. The second thing that I see a lot is that people miscategorize items, and that to me is that they are putting the expenses or income on the balance sheet rather than on the profit and loss. Not necessarily, sometimes there is miscategorization within the profit loss, but at least they're on the right side. You're trying to expense or show income. But making sure that you have them in the right accounts is important. I know on QuickBooks Online, a lot of times there's some defaults that, especially if there's an income, it will go to an uncategorized asset account and people just click match, and then we have problems because it's really should be an offset to an expense account, or it should be a transfer from a balance sheet account. So that's another very common mistake, is miscategorizing items. And then the last one I see a lot is that people are duplicating their income. So they're overstating their income. They receive payments, it goes directly into their bank account, and then they see a deposit on their bank feed, and they put it into the income account as well, when they really only should have been doing one or the other. So those are the three most common mistakes that I see when I'm cleaning up your financial statements and your bookkeeping.
Thank you, Nikki. How about you, Sabrina, from the tax point of view?
Yeah, and those were really great, actually, Nikki. And I think mine sort of fall in line with some of what you said already. The one, I think the first one that I have seen, I think more frequently this last tax season than I had previously, is the issue of something changing with the prior year numbers. And I think there's a few different reasons for this. I think that sometimes it's, for whatever reason, and Nikki can probably speak to this better than I can, something in the software that causes that, and the books were never closed, what we call closed. Once you're at the end of the year and everything's adjusted and filed, we usually close the books. But I think sometimes with QBO and maybe some of the other softwares out there, sometimes it can be easy to have something get pulled in afterwards. And I think a good example of that would be like a credit card expense that somehow was not reflected when we prepared the tax return, and then we notice it the next year because we can't balance everything, because we do have to report the balance sheet numbers beginning to end and have everything work out and reconcile as us accountant nerds want it to do. So that is, when I'm usually often in QBO working around, and so I'll see something there and kind of dig further, but we always notice it when we're trying to reconcile because there's a difference. And so you have an issue where you may need to amend the prior year because maybe there was an expense, there were expenses that were missed that you didn't deduct. So I think that's the biggest one that I've seen more recently. And kind of going along with what you said, Nikki, except this is really more specific, but I think I see it a lot with surrounding payroll sometimes. And I think this depends also on how you're doing your payroll. Are you entering it yourself? Is it automatically being booked as part of, if you have the Intuit payroll service or something like that. But it kind of goes to what you said, Nikki, about the potential of duplicating something. And where I see it a lot is, or where I've seen it in the past, is like payroll tax is a good example. Because if you are recording payroll, or it's being recorded somehow, and you have taxes that you owe on that payroll that you're running, typically it will go to a liability account on the balance sheet. And when you actually pay it out, you're supposed to reduce that liability. And I've seen it before where it just gets added to the expense a second time. And again, without getting too technical with it, you're duplicating expenses. And that's a big problem. And typically you'll see a sign of that if you look at the balance sheet and see a really inflated liability number that's bigger than it should be. So I think I probably have more, but I think those are a couple of the main ones. And again, the payroll one's really specific, but as Nikki said, anything like that, you have that potential, and especially if you're not reconciling, as you said, of duplicating something somewhere, and then your bottom line is off. So that's very, very important.
Great, thank you, Sabrina. For the clients that we prepare their financial statements every month, we did a survey a while back, and we said, how many of you are opening your statements? And then how many of you that are opening your statements, do you understand what it means? Does it give you action items? And we found that a lot of people will look at their financial statements, but just say, okay, now what? I don't know what it means. What am I supposed to do with this? What are my options? And so that's the purpose of this webinar today, is just to kind of give you an overview to know what to ask, because sometimes you're not sure what you need to do. And one of the things that I wanted to share with you is the reason why and how you can understand your financial statements and interpret them. Some of you know, some of you don't know that I wrote a book. It's called Your Financial Flight Plan. If you want a copy, let me know. Be glad to send it to you. But I wanted to share with you, and it's a poor copy. I'm sorry about the copy of the book, because I just copied it. But in my book, I talk about financial statements, and I compare flying an airplane with running a business. And it's similar to the cockpit in an aircraft. And the cockpit will tell you how fast you're flying, So your speed, your altimeter, it tells you your GPS, where you are and where you're going. That's the purpose of your financial statements, is to tell you where you are, where you're going, and if you're going to hit the mountain or clear the mountain. And so I just want to highlight a couple things in the book, just by saying, you know, the financial statements are the CEO's instruments. It's like the captain reading those indicators in his aircraft, knowing where he is. Business owners and managers can read the financial statements. They can make intelligent decisions. So if you don't know what it's saying, what it means in English, how are you supposed to take action to improve your situation? Let's see. I put here, so you're running your business and you're flying at an altitude of 37,000 feet. You're headed towards the destination, but the company is experiencing some bumps along the way. As a pilot, you know the ride will be smoother at 27,000 feet. As a business owner, you know that cutting your spending by $10,000 will decrease the stress that you feel when paying bills. What do? Do you know how much you're spending in telephone, meals, gas, advertising? That just talks about net worth. So if you're running your business and you don't know what your financial statements mean, it's like operating your business in the dark. You're going to have thunderstorms, there's going to be clouds, you don't know what to do. But as a pilot, they read their instruments so that they know exactly where they are and how you can make a difference. Meaning, are you scheduled to land in Ireland or in California? You know, where are you going to land your business, and are you going to make it there? So that's what I wanted to share with your financial flight plan, and it just is a fun way to compare flying an airplane to running a business, and I talk about other qualities in addition to that. So whether you use QuickBooks or not, we love QuickBooks Online. We have some clients that work with QuickBooks Desktop, so that's the QBDT. Or you can have any other financial statement. But what we do, what I recommend, is looking at one line item. Now in QuickBooks Online, the phrase is net operating income. So you have income, you have expenses, and then there's this line that says net operating income, and it shows an amount. On desktop, it says net ordinary income. Means the same thing, but depending if you're in QuickBooks Online, QuickBooks Desktop, you look at this one line. And this one line, whether it's a profit of $9,700 or a loss of $1,700, this line should tell you exactly where you are, if your plane is going to be able to cross over the mountain or hit the mountain, because you're going to have your chart of accounts set up properly to know everything that's deductible in your entity is above the line, and then net operating income will show the accurate amount. Let me give you an example. If you, and I know somebody on the line here is a sole proprietorship entity. So if you're a sole proprietorship entity and you look at net operating income, you can take that $9,700 and in your mind, on your calculator, you can multiply that by 15.3%. Now that 15.3% is self-employment tax. A sole proprietorship gets taxed a second way, which is personal income tax, and that varies person to person. But in your gut, you can know $9,700 times 15% is X, and you can know exactly how much you're going to owe in taxes. The same is true for a C Corp. For 2018, a C Corp is going to pay 21% tax straight across the board. So you take the $9,700, multiply that by 21%, and you're going to know exactly how much you're going to owe. S Corps are a little bit different, but we'll talk about that in a moment. But I just want to kind of give you the idea of focus on this line every day, every week, at least every month, so that you know what that total is, especially year to date. You're going to look at, so this is October, you're going to look at your September number for the month of September, see how you're doing. But you're also going to look at January through September to see what that total is year to date. so that you can have that 15.3% money set aside for self-employment tax at a minimum, or maybe you're making an estimated tax payment and you need to make that January 15th. So this really helps you know exactly where you are if you have your chart of accounts set up correctly. And I'm going to give you some tips for that. All right. Now, your entity is going to determine how you set up your chart of accounts. And I'm going to go into some details here, but you could be an LLC, a partnership, an S Corp, a C Corp, or a sole proprietorship. And I'm going to give you some ideas of what that looks like. I want to talk first about some variances, and this will become very practical as I go through it. So the first line item there says owner's medical. For owner's medical, if you are a sole proprietorship business, you are not going to list owner's medical above the line. So remember, the above the line is your income, your expenses, and then the net ordinary income number. If you are a sole proprietorship, owner's medical, you can pay it out of your business account, but that is a below the line item, meaning it's not directly related to a deduction for your Schedule C, which is a sole proprietorship tax form. So think of it in an opposite way. If you're a sole proprietorship and you pay for your medical health insurance out of your business account, which you are allowed to do, and you put it above the line, what that's going to do is that net ordinary income number of that $9,700, the $9,700 is going to be less because you're deducting health insurance. And so when you do your 15% calculation, you're going to be wrong and you're going to end up owing more. So here's the key: is if any of these any of these expenses are above the line and you're not supposed to put them there, you're going to be in trouble paying taxes. If they are expenses that are supposed to be below the line, then you're going to have an accurate amount on that net ordinary income, and you'll be able to, in your gut or guesstimate, an idea of how much you're going to owe. So owner's medical for sole proprietorship goes below the line. For an S Corp, that is subject to your wages and it's going to go above the line. For a C Corp, you're going to have that above the line. But if you look at the next line item for contributions, speaking of a C Corp can deduct contributions. You give to charity in a C Corp. Here's the thing: you can only give up to 10% of your profits in a C Corp. So you're going to say you give $1,000, but depending on your profits, if it's not enough, some of that contribution has to go below the line. I was going to say similarly, but that's not correct. As a contrast, if you are an S Corp, and I know there's several S Corps on the line, if you give to charity through your business, it is not deductible for your business entity. So you do not want to put it above the line. You want to put the contributions as a S Corp below the line. The good news is we record it in your tax return as a contribution, but it is what we call a flow-through expense, meaning you don't get a deduction for your S Corp, but it's going to flow through to your personal return, and you're going to get the deduction on your personal return if you qualify. Taxes paid. So if you're an S Corp and you pay the $800 fee to the state of California, that is a deductible expense. But if you pay federal taxes as a C Corp, that is not deductible. So depending on your entity and the type of tax that you're paying, federal or state, those expenses for taxes paid will go either above or below the line. Now, if you're sole proprietorship, any taxes that you pay are below the line. Again, we don't want to understate your profits. If you put them above the line, It's going to reduce your profits, reduce the self-employment tax that you're calculating in your head. Now, loans from owners. If you're sole proprietorship, you can put money into your business. That's going to go on the balance sheet if you want to track that. But the IRS doesn't really care too much about any loans from an owner on a sole proprietorship, other than, you know, why are you loaning the company money? You need to earn income, and is there a hobby loss issue here? But for an S Corp and a C Corp, if any owners loan the company money, that's a balance sheet item, and you need to have a promissory note, a repayment schedule, and if it's over $10,000, you need to charge interest, meaning there's probably going to be a 1099 INT for interest charge, depending if it's an asset or a liability for the corporation. The draw, distribution, dividends item here, they are different words, but they mean the same thing. For example, if you take money out of your sole proprietorship business, the word that you want to use is it is a draw. If you take money out of your S Corp business, that is a distribution. It's outside of payroll. You just pull the money out. And if you take money out of your corporation, a C corporation, and you pull the money out, that is called a dividend. That is taxed twice, so double taxation. You probably heard that phrase. And a 1099 DIV is required for that. A couple other variances is IRS allows you to commingle personal expenses with a sole proprietorship. In my opinion, that's why they go after a sole proprietorship for the audits. More sole proprietorships are audited than any other entity because people commingle and they're trying to get them to confirm that they're recording their business expenses appropriately. But if you're an S Corp, C Corp, you do not want to run any personal expenses through there. I know there's an occasional oops here and there that might be understandable, but do not run any personal expenses through corporations. Now, and the personal expenses would be, again, a below the line item for a sole proprietorship or a distribution for an S Corp, which is a balance sheet item. Estimated tax payments are below the line for a sole proprietorship, and typically for an S Corp, you're not making estimated tax payments for the corporation. So that's really a distribution for an S Corp, which is a balance sheet item. So you can see, you know, one's a P&L item, one's a balance sheet item. Now, when you have auto expenses in your books, you can put them above the line. That's okay for all entities. But one thing you need to be aware of is the IRS allows you to take the higher of two numbers, either the actual cost that you spent for gas repairs insurance, or taking the mileage rate, the IRS mileage rate multiplied by the number of business miles that you took. But keep in mind that many people do miles. Usually it can be a higher deduction. And so if you're going to get a deduction for miles, it might be higher than the actuals. So just kind of be aware that that net ordinary income number for auto is going to be a little fluctuating because you might have a higher deduction for your auto miles than you do for your actuals, or quite the opposite. You might be putting down 100% of the actual costs, but I will tell you, it is a rarity to have an auto be 100% business use unless you have a van and you're a carpet installer and you're only using that van from your storefront to a client's, say, residence and back and forth. I had a client ask me or tell me that they're looking to buy a vehicle to use it 100% for their business, And the IRS is going to look at that and say there has to be some, they call it subject to abuse, meaning there's some personal elements in there that you drove to go get a gallon of milk, to go to the grocery store. So be careful when you're putting 100% of auto deductions and you're only having 75% of that deductible. So that's going to affect your net ordinary income number. Now, home office deductions for all entities should be paid for by the owner personally. For an S Corp, what Sabrina does on the tax side is we do a home office calculation, and then we do a journal entry in your books to show what amount that you got deducted and it came from you personally. So we kind of offset distributions or loans if there are anything there. For a sole proprietorship, again, you're going to pay for that personally, whether you rent or own your home, and that is not an above the line item. That is an below the line item if you happen to pay, your rent or utilities for your personal home out of your business expenses. The last item here I just want to talk about, it kind of relates to all entities. It doesn't the chart of accounts doesn't change by the entity, but I just wanted to make sure you guys are aware that meals are 50% deductible. Entertainment used to be 50% deductible, but now for 2018, it's 0% deductible. Gifts have a limitation of $25 per person per calendar year. So if you're giving a bottle of wine that's $30 to somebody, $5 of that is non-deductible, so technically that's a below the line item. Obviously $5 is not a big deal, but if you are giving $100 gifts, $200 gifts, and you can only deduct $25, keep in mind that the difference needs to be journaled into your books as a below the line item. And penalties are never deductible for any entity. Okay, that's a lot of detail. Let's look at some statements. Give me a moment. I've got a statement to show you here. Let me make this bigger so you can see it and move a couple screens here. So please disregard the year. I did a webinar back in 2007 about this topic, and I didn't want to recreate the wheel. So I'm using the same statements. The idea is the same, just don't look at the year. So this is an example I did for a law firm, showing income here. Now we go down to the expenses, and he has advertising, business gifts, licenses, and then notice how the car expenses are split between a Lexus and a Mercedes. And the reason why that this attorney did it this way is because each of the vehicles were a different percentage of business use. So the Lexus of 14,000, maybe it was 75% business use, and then the Mercedes could be 10% business use. So depending on his entity, it could be some distributions in there if he's an S Corp. There'll be some wiggle room with the auto expenses. He has conferences and seminars, dues and subscriptions. Again, entertainment, not deductible. But I love how the insurance is split out. I was having a conversation yesterday with looking at some financial statements for a client. They had auto expenses and one total, and they had insurance expenses as one total. My question was, is there auto insurance posted to the insurance category, which then should go into the auto expenses? Because if, as a tax preparer, Sabrina can confirm this, when you see insurance, you're going to plug in the full $18,000 amount. If we don't know that there's auto insurance in there, we're just going to post to the whole amount. But if we see auto insurance, Sabrina knows, ding, 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 I'm going to take that out and plug it into the other auto expenses and mush that together based on actuals or business miles. Because we don't want to do something wrong on your tax return if you maintain the books and you're not showing your insurance correctly. So interest, maintenance, meals, office supplies, postage, professional fees, rent, computer repairs, telephone, travel, utilities, gross wages, and then the total expenses down here. And then you'll notice, oops-a-daisy, net ordinary income. So if this were a sole proprietorship, you could take the 105,000, multiply that by 15%, 15.3. You would have to also know your tax bracket. You could be paying 10% in 2018. You could be paying 37% in 2018. But at least you get an idea of what this is going to be. The C Corp is easy. That's 21%. You're going to know what the taxes will be there. The S Corp is not as easy to calculate the percentage because it's based on your personal income tax bracket, because the profits in your business kind of go over to your personal return. Now, this net ordinary income, I don't know, maybe Sabrina will correct me in saying it differently, but what we want to do is set up your chart of accounts for an S Corp such that this net ordinary income is super close to your K1 amount. That way, you know, it will flow to your line 17 on the 1040, at least on the 2017 return. That won't be the same for the 2018 return. But at least you'd have an idea that that's your K1 number. Now, anything below net ordinary income is what we call below the line. So you can see here contributions, non-deductible business gifts, non-deductible meals. They're just doing a journal entry to split out 50% of the meals, non-deductible entertainment, owner's health insurance, and personal expenses, along with estimated taxes paid, as well as federal and state taxes paid. I believe this was my example of a sole proprietorship, and that would make sense with all the below the line item accounts. I'm going to go and show you one more statement, and then we'll go back to the PowerPoint here. I love this report. This is a profit and loss by month. My team knows that I call this a trend report. Why? Because this report allows us to spot trends. Trends if your income is going up, trends if your income is going down. It also allows on the expense area, if you have a brick and mortar office, shop, you're going to see rent, 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 and it's going to be the same amount across the board. Doesn't it give you a great feeling when you have that affirmation in your gut of seeing the same amount going across the board? If it's not the same amount, you know something's going on, and it could be logical. Maybe you're moving and you're paying double the rent in 1 month. Makes sense. Maybe something's posted incorrectly. So now you need to dive into there and figure out, why is my rent higher and you're not moving? You can look at any of these categories: bank charges, dues and subscriptions, postage, insurance. You know, a lot of times you pay insurance maybe twice a year, or some people pay it for 8 months and then they go dark for the rest of the year. So it's a really nice report to kind of check in your gut that everything is logical. And if it's not logical, you need to ask why, who, what, how, what's wrong, and be proactive to asking those questions of us if we are your bookkeeper, or of yourself because you're doing the posting. So make sure you're pulling this report every month to take a look at your year-to-date numbers as you go through there. All right, let me close that and close that. I'm going to end the presentation before we go to our questions with some sense of humor, because us accountants, we have a great sense of humor. It doesn't matter how much you scoot around the office in your swivel chair, you can't deduct that as business travel. Love those cartoons. Make sure you're getting our newsletters. We send them out 3 times a month, and they're all educational. I don't want you to miss out on that. I try hard to share that and get the word out so that you can be successful in your business. So make sure you're getting that. If you're not, shoot us an email and let us know, and we'll add you there. As well as checking out our Facebook page. On our business page, we have over 1,100 fans, and we're posting daily there tips and things that you need to know about, whether it's tax reform or anything like that. Speaking of tax reform, we have recorded webinars that are on our website. This is the link to the webinars. You just plug in your name and then you get free access to those webinars if you haven't viewed them. We have one for individuals, one for businesses, and that fantastic 20% deduction for small businesses. If you don't know what we do, we are a one-stop shop. We love helping businesses with payroll, bookkeeping, business taxes, and individual taxes. I wanted to let you know about the webinar last month. We did a webinar on home office expenses. If you're interested in getting that recording, do email us at support@adminbooks.com. And our next upcoming webinar is going to talk about employee versus contractor rules, 1099s. There's actually the Supreme Court of California ruled in April this year, changing the rules for contractors. And so we're going to be also talking about that. If you guys have some ideas of topics that you would like for us to cover, please email us, let us know. We want to be of service to you and give you value. We click here again. And here's our information. You know how to contact us. So now I'm going to pause for a moment and see if you guys have any questions, whether it's about reading and interpreting financial statements, home office deductions that we did last month, or something totally off topic. We are here for you, Sabrina and Nikki. We can answer any bookkeeping, tax question. Kind of keep it general if you can. If you have a question, sometimes it's hard to answer a specific question, but we will do our best. And if you're muted, you're going to have to unmute yourself. And if you're too shy, that's fine as well. There is a chat box here, and I can look at the chat box, but I'm not going to string this out. I will give you back, 15, 20 minutes of your day and close the webinar if nobody has any questions. Any final call? Anybody have a question?
I do have a question. This is Catherine.
Catherine, hey, how's it going?
Hi. So good. So my question is the below the line expenses, which I understand now are those expenses that are not tax deductible. When we are entering those in our QuickBooks, do we enter them as normal, or are we only entering those as a journal entry?
You enter them as normal. The only thing you need to be aware of, instead of an expense, it's going to be an other expense. And that will bump it below the line. But everything is going to be normal.
So we classify it as an other expense. And I like how on that financial statement you showed us how he'd got like those subcategories.
Yes.
So basically, like if we, let's say, for example, I was feeling generous, and I bought an employee a $50 gift, and I'm knowing that only 25 of that can be deductible. So I'm going to enter, essentially, I'm going to split that into two entries. So one entry will be an expense as a gift of $25, and then I'll enter it at another $25 as an other expense, as a non-deductible business gift, correct?
Partially. What I would recommend that you do is if you give a gift, say to a client or a potential client, and it's $50, you're going to have the expense. I know you use QBO, so you're going to have the, whether it's a credit card charge or a check, I'm just kind of making it up there. Say it's a credit card charge. The total is going to be $50. You're going to have the first line item there be posted $25 to the gift. And then the second line item would be other expense, non-deductible gift, $25. Instead of two entries, it's going to be one entry, and you can split it 50-50, whatever the total is there. I highly recommend that you use the memo column generously, like who you gave the gift to, because when the IRS audits taxpayers, it's usually 3 years after the fact, and you may not remember who you gave that bottle of wine to. So use the memo generously there, and that's how it's handled for client gifts, is you can split it that way. Or one thing that might save you time is if at the end of the year, either you, and I know you work with Mimi as well, what we can do is see what your total gifts are, or this is a great example for meals. So say you had $1,000 of meals, you could just do a journal entry at the end of the year and split the meals 50-50. But when you're doing the gifts, yes, like if you spend $100 on a bottle of wine, you would do $25 gifts, $75 non-deductible.
Right. So it's better for me to like let's say I put it on my credit card, right?
Mm-hmm.
It's better for me to enter that information just as you described. So then when Christina, my office manager, comes to match it up, she's going to match it up to that, and it's already going to be in place.
Correct. It'll match beautifully.
Okay.
That's a great question. Thank you for asking that, because I was not clear on how you get those expenses below the line. So thank you. Appreciate that.
Yeah, and that's helped to clarify, but I like to see the visuals are a great tool for me.
Yes, I'm so glad.
Same here.
Me too. Anybody else?
This is Pat.
Hey, Pat.
So you end up creating the journal entry accounts, and then they're mapped to go below the line in the setup. I want to utilize this, and I know it has not been utilized in our books before.
So I heard most of what you said. Something I didn't hear the beginning. Something about you have journal entries set up. Could you articulate it a different way and say it again, please?
I'm sorry. I know we do not have any chart of accounts set up for non-deductible expenses, and I do want to do that. You probably remember from our meeting last week.
Yes.
That was being done basically in someone's head, and let's not do that.
Right.
Yes, I think the conversation needs to be, what transactions do you want to do monthly when, we help you close the books each month, and what expenses really can be done at the end of the year. Some expenses you can't kind of in your head knowing gifts are, $25 per person. And as the year goes on and the amounts get larger. So allow us to brainstorm with you on which ones we want to split and which ones we want to leave alone and have Sabrina do at year end when we do the tax return.
Okay, thank you. That sounds great. And can I clarify on gifts? Is that only clients, or does that apply to employees? We sent a large floral arrangement for one of our physicians' family members who passed away, and it was obviously over the $25.
I'm going to let Sabrina kind of brainstorm on that for you.
Yeah, that's a really good question. I think my gut feeling, Renee, and feel free to kind of chime back in on this, but I feel like it's probably across the board for everyone. Now, Patty, can you tell me again who that was for? So it was for a physician's wife, is that what you said, or?
Yes, one of our physicians, a shareholder, his wife.
Okay, to me, it's it's the shareholder / employee, it's his wife. To me, I feel like it would be treated probably similarly to an employee gift, which would be limited, which would be limited to the $25. Renee, I don't know if there's really any exception to that offhand. I haven't seen it myself.
Mm-hmm. Yeah, you could have the $25 limitation, but here's a twist to the gift limitation. You can give a gift to a corporation, meaning a C Corp, and if the company can benefit from it, it's 100% deductible. Not many people know about that. So let me give you an example. if you wanted to give Renee Daggett tickets to the movies and it was $50, and I could be the only one to use that, there would be the limitation. Let's pretend like it has nothing to do with entertainment though. But if you sent the flowers, like in your example, to our office that everybody can enjoy, because I am a C Corp, then you get to write off 100% of that. The issue is you don't always know if what their entity is, but that's how they handle that. Now, I will tell you, some people get creative and post those types of flowers and chocolates or whatever to marketing or advertising, and they feel comfortable with that. Now, obviously, if we don't do the books and we just see, advertising and marketing, we're going to plug that in there and not question it. But if you're in an audit situation and they look at that and they say, ooh, 1-800-flowers.com, what was this for? And you have to just be ready for answering that. The IRS can be ruthless, but I just want to let you know that, where you post it will determine its deductibility, whether it's 100% for the corporation, 100% for marketing, or $25 limitation per person.
Great, thank you for that.
Yeah, and Renee,
Another question.
I'm sorry, Patty. I just wanted to chime in a little bit on what Renee said, because that's a really good point about the creativity with putting it in like advertising or marketing, which I don't think would apply to your scenario, Patty. But I've seen that before. I will say it scares me. I think it's getting creative. I had a tax partner years ago that would do that, and it really bothered me. I think, again, it depends on the situation, but there are people that do that. And again, as Renee said, they feel comfortable with it. If they can justify, if they gave, 20, whatever it is, $50 to towards a school event or something like that, and they feel like it's community building and it's marketing themselves. So I just think it's a great area. So I just wanted to add to that, Renee.
Perfect.
Creativity.
I missed some of that. But
there is a variance in the creativity level.
yes, correct. That's right.
Also, the risk in your comfort zone. Some people want to, push the envelope. Some people don't want to cause red flags even when they qualify for a home office. So everybody has different levels, whether it's the taxpayer or the preparer. And that's what you need to do when you interview a tax preparer is, what is their risk? Are they teaching you or educating you how to qualify for expenses if you don't already, or are they pushing the envelope? I actually know an enrolled agent that pushed the envelope, and he basically said, oh, I'm posting it here in hopes that my client will get audited so I can set the IRS straight. To me, that's dogmatic and it's wrong. So you have to know what your tax preparer's thoughts are on these situations.
Great. And can you speak to the comment on the home office expenses? Both in the webinar and then today you said that the person should be paying those rather than the corporation. What are the issues if the corporation does pay, knowing of course there will be some sort of an adjustment? Would that be similar to ours, or is it a deal breaker?
So let me speak to S Corps and then C Corps because we have both on the line. So for an S Corp, it's best for you the owner to pay for all of that personally, whether you own your home or rent. So what we do is if you rent, we take that and utilities, and we figure out the percentage of square foot and the percentage of business use. And then we enter that in on an S Corp return as rent, but it offsets distributions. C Corp is a little different, especially when you have as many owners as you do. And I would not recommend that the C Corp pay for that, because everybody, it's kind of like one person can live in a very modest home and another person can live in a very lavish home, and there's variances on that. And so it becomes what's the word I'm looking for? It starts with a D. It's not equal.
Discriminatory.
Yes, thank you for saving me. And so this will be something that Sabrina will be talking to you, Patty, specifically about your situation, whether it has to do with home office, autos, you know, those kind of things. So, but those are
And Patty,
general.
I just wanted to add to that, Patty, I know that in your situation, there's also the unique, you know, we talked about if for example, the doctors have a business line that they use solely for like the business internet and they use it only for that. And I think that was one of the kind of the unique items that you talked about. And I think as Renee kind of alluded to, that's a little bit of a gray area. I mean, I usually would side with what you're saying, Renee, that, you know, you want to keep that kind of coming out personally for each of the doctors. But that's a little different because it's 100% a business tool, I guess. So I think that that's a little bit different. And I know we need to follow up with you on that. So I'll give you a little more information on that, but I think that yours, again, is a little bit different. So, but I think that by and large, you want to keep it personal and handle it that way versus the corporation just paying it.
And that's for discrimination purposes? Or is it an IRS requirement? What is the reason, you know, so that I can defend that position?
Well, I'll just say that I think it's cleaner from a, you know, kind of a bookkeeping standpoint, and I just think it's cleaner. I mean, I think that's the number one reason. Because so again, Patty, if everyone's paying personally and then you're reimbursing, which again, we'll kind of dive more into that. I just think it's a cleaner way of operating than if you are paying it and then having to somehow adjust for personal use. And again, we'll have to talk about all of the ins and outs of that. I just think it's cleaner from a recording standpoint. I don't know that IRS really says anything for sure on that, Renee, and correct me if you know anything else on that, but I don't know if they really say for sure. I mean, I think we have general information about how it's calculated, but I don't know if there's a hard and set rule on that.
Yeah, for C Corps, I have never seen anything written, but imagine in your mind's eye, what does Apple do? What does Facebook do? What does LinkedIn, you know, what do all these big corporations do? Are they, you know, paying for, you know, Bill Gates' home office out of the corporation? No, they're not doing that. So it's just a cleaner, easier way to track. And that's why we do it in a C Corp that way. S Corp's a little different on the personal side. Sole proprietorships, I know that there's a sole proprietorship on here. Again, you pay for it on your personal side, and we show it on the tax return. That will reduce your self-employment tax, so that's always good. So, but again, that's a below the line item for a sole proprietorship.
Okay.
If there's one more question, I can take one more question.
I'm going to chime in. This is Catherine again, if that's okay.
Absolutely.
Well, we're on the issue of home office. So I think we've gone back and forth where I guess I actually have an office where I work out of, rental space, but I do work from home, as does John. So there's still bandwidth in us being able to use that potentially as a write-off.
Yes.
Even though I've got a home office, even though I've got a regular working office, I guess.
Correct. And it's because in order to qualify, it has to be regularly used, exclusively used, and it has to be a place that you do administrative tasks there. Right. They call it a principal place of business. I recommend, Catherine, shooting an email to support@adminbooks.com. Get the link for that home office webinar that we did last month, and we talk about that.
Okay, I did get that link, so yeah, I'm going to watch that.
Oh, perfect, perfect. Well, I just want to thank you guys for joining us for the webinar today. Thank you so much for your time. I know it's valuable. I hope that this has been helpful to you. Let us know any topics that you want us to discuss. Early December, we're doing the employee independent contractor rules. What do you need for 1099s? And then the new Supreme Court California rule that those of you that need, that hire contractors, you guys need to know about that. So thank you for your time and joining us, and we'll see you soon.
Thank you.
Thanks, everyone.
Bye-bye.
Thank you.
Thank you.